maximise.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
All right, it's coming up to my favourite time of year, tax time, so let's get stuck in. Welcome back to an episode of Equity Mates, a podcast that follows our journey of investing, and whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. Now, if you're just getting up to speed with the basics, we recommend that you go and check out our podcast, Get Started Investing, and then come and join us here on the main show. But with that said, my name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce.
That's good.
Thanks for coming in today. Take a seat. Let's unpack why it's your favourite time of year. What sickness do you have in your mind that leads you to think that this is the best time of year?
It's a nice refresh halfway through the year. 6 months in, you get
the volume
calendar new year.
The volume of paperwork that you have to fill out.
No paperwork.
The amount of scrolling you have to do back through your banking apps to figure out what you've spent and what you can claim.
No, Ren.
Is
none
it
of that.
the frustration of realising that your broker hasn't actually produced a tax report yet, and so you can't actually submit your tax return?
No, none of that.
Is it the cost that you have to pay to an accountant or a tax professional to help you do it?
No, none of that.
What is it?
I just told
like
you,
it so much?
it's a refresh. It's an opportunity to review portfolio, make sure that you're setting yourself up in the right habits financially going into the second half of the calendar year.
Well, this podcast is for all the sickos like Bryce who love tax time and all the people like me who just get through it.
Well, you shouldn't just get through it. You should pay more attention to it, Ren. And luckily, in today's episode, we are continuing with our Ask an Advisor series. And if you've just joined us for the first time, welcome. The Ask an Advisor series is the chance for you to ask some of Australia's best financial advisors your questions. We understand that financial advice is expensive and it's pretty inaccessible for a lot of us. So we bring them into the studio and ask them your questions.
That's right. The numbers are pretty stark. 2007, 20% of Australians had a financial advisor. The latest numbers suggest just 10% of Australians have a financial advisor. So this show is our small part to help the 90% of Australians, which include both of us, who can't afford a financial advisor, ask some of their biggest money and investing questions.
And we've had a lot come in around tax, given that we're just about to close out the financial tax year of 2023. So we are joined by Andrew Wilson, who is Managing Director at Wilson Chartered Accountant. And we have plenty of questions to get through in today's episode that covers general tax questions. We cover investments, and we also cover deductions, everyone's favourite.
Oh, wow.
Everyone's
To
favourite.
be fair, that is everyone's favourite. I'm not going to dispute that.
How can I squeeze deductions?
Now, I actually wasn't here for this interview. I was still over in the United States. Is that a tax deduction, the US trip?
Yeah, there's elements of it that would be a tax deduction for sure.
Great.
Because it was for business purposes, and you can make the link between that and income derived from our business, as you will learn in this episode, Ren.
Well, yeah, so I wasn't in the room for this episode, so expect to hear 45 minutes of two people that love tax time speaking giddily about it all. But it is important to note we are licensed, but we are not aware of your personal financial circumstances. And especially when it comes to tax time, the rules that Bryce and Andrew are speaking about generally on this episode may have a different application based on your specific financial circumstances.
That's it.
So if there's ever a moment to pay a professional to help you, it's tax time. So speak to a tax professional to see how these general rules apply to your specific financial circumstances.
Now, Ren, you mentioned at the top there that you're aimlessly scrolling through spreadsheets and bits and pieces and trying to find pieces of paper and receipts and all sorts of things and understanding when you sold stocks and when you didn't. And it sounds a bit chaotic over on your side.
I'm going to butcher your segue here and just name and shame one broker. One broker doesn't give you a tax report until the end of October.
Yeah.
I'm not going to mention who, but
that's annoying.
It's annoying.
But anyway, a lot of people
But where you're segueing to will solve this problem for me.
Well, yes, it's important when it comes to tax time that you have an easy way of tracking your investments so you can report capital gains, dividends, capital losses, A platform that I use to do that, I've moved away from my spreadsheets, is Sharesight. They let you track investment performance over the life of your portfolio. You can look at your capital gains, as I said. You can track your capital losses. It is super helpful, not only at tax time, but generally throughout the year, just to see general portfolio performance. Now, you can sign up for free if you have less than 10 holdings. Great, go on, check it out, see how useful it is. If you have over 10, it does become an annual premium subscription. But the good news is through Equity Mates, you can save 4 months when you purchase an annual premium plan. All you need to do is go to sharesight.com/equitymates. We'll put that link in the show notes and give it a crack. It's certainly helpful when it comes to portfolio tracking.
Now, here's the question. Is a Sharesight subscription tax deductible?
I think it is, yeah. Ask your tax advisor. Ask your tax advisor. But you could argue it. But anyway, we kick off this episode with deductions, Ren, so that feels like the great point to get stuck into this interview with Andrew. Well, Andrew, welcome to the Equity Mates studio.
Thanks for having us, Bryce.
Now, tax time, end of financial year tax time. We have gone out to the Equity Mates community to give them the opportunity to ask all of their tax questions. It is Simon in our office. It's his favourite time of year when he starts thinking about all the deductions that are available.
All the deductions, the deductions coming out of your back pocket.
Exactly. So we're going to break this into 3 sections. We're going to generally speak about the deductions and I guess how we can think about them, how we can make sure we're not missing any, have a chat about concessional super as well. Then there's some investing specific tax questions, and then we'll close out with just some general ones that have come in from the Equity Mates community. And a reminder, as part of our Ask an Advisor series, you can also submit questions. We'll let you know when the next episode is coming. But Andrew, let's start with deductions. What are the key deductions and tax offsets that are generally available, and how can I make sure that I am claiming every single one that I'm entitled to?
Yeah, sure. Bryce, that's the $1 million question, right?
Yes.
You know, what can I claim? What am I eligible for? The challenge is, mate, it's deductions that you're eligible for are largely, occupational or industry specific.
Yeah.
For example, what a tradesman builder is eligible for is going to be different from what a financial investment advisor would be eligible for. To give an example, tradies can purchase protective clothing, steel cap boots, eyewear, high-vis and the like, while an investment advisor who travels the same office every day, 9 to 5, wears a suit and carries a briefcase is obviously going to have a different set of eligible deductions, okay? Unfortunately, the ATO take the view that a suit is a personal type attire and you can't claim for a suit. However, if you're a tradie and you're wearing high-vis and boots, they are eligible deductions, okay? The 2 key things to consider when trying to decipher what deductions you may or may not be eligible for is firstly speak to your tax agent, because they're an expert in that.
I feel like this is going to be a common theme through this episode.
You might hear me say that quite a bit in this conversation. But speak to your tax agent, and the key is also being able to draw a nexus between your occupation or the income that you derive and the expense that you incur. Okay, and the word nexus is it's all over the ATO website. It's what the ATO will look at when you try to verify and claim your deduction, the clear connection and nexus between your income and expense.
It's not black or white, I feel. It feels like it's, or is it when you go on the website and can you filter on like industry specific? Let's, for example, Simon here in the office, he's trying to look through this. We obviously work in media and financial services. Given the amount of podcasting and media work that we do, could he claim like his Spotify and Netflix accounts?
Look, that is another question I get quite a bit. Short answer, if there is a nexus, so for example, if Simon needs to check that on Spotify that an ad particularly played up at a certain point in time,
yep,
or that a podcast that he managed covered a particular topic or whatever it might be, and Spotify becomes essential to the operation of his occupation, and that he's obviously paying for the paid subscription of Spotify and he's paying his $9 or whatever it is at the moment a month, then yes, he can claim Spotify. However, one of the key things is to remove any personal use.
Yeah, so it's not the entire monthly.
Absolutely. So, if he's listening to Metallica for 9 out of 10 hours a week and he's using the last hour on his Spotify.
He does do that,
actually. He's using his last hour to check, that the ads are coming on and that his podcasts are running as anticipated, then, he could claim 10% of that cost.
In terms of recording that, does he just need to somehow just note somewhere that this week it was 10%?
You got to be reasonable. You don't log it every time you jump on Spotify. But to use your mobile phone, for example, a real estate agent obviously taking lots of phone calls from buyers and sellers and what have you, but might jump on Facebook at the end of a Saturday afternoon to check their feed or whatever. Then they might pull out their phone bill for a month or two. They'd highlight it and go, okay, I've got a 90-95% work-related use because every now and then I incidentally do something personal, right?
Yep.
So then you'd claim a 95% use. You don't have to check it, for the full 12 months a year, but you might do a good sample and push that out over the course of the year.
So just to kind of summarise that, if there's a clear link or, as you say, nexus between your occupation and the income derived from that expense, then you're probably in the area of being able to claim some sort of a deduction.
Yeah, absolutely. There's a connection there, then it's at least worth investigating and talking to your tax agent about.
Nice. All right. Well, can you explain the rules and requirements for claiming deductions related to home office expenses for all of us who are now finding that we're probably working from home way more than we were pre-COVID, and I know the government brought in some easy rules for us to help with this. I'm not sure if they still stand. So help us through understanding home office deductions.
Yeah, you're absolutely right, Bryce. So during COVID, there are a few methods. I think there was 3 methods off the top of my head that you could claim working from home deductions, but they've recently revised that as we sort of return to a bit more normality and people are returning to the office, that they've now cut that back down to 2 methods, and they are the revised fixed rate method and the actual cost method. Now, under the fixed rate method, you're entitled to claim 67 cents per hour that you work from home, but that hourly rate covers things such as your data and phone usage, electricity and gas, printer ink, stationery and the like, okay?
67 cents on the dollar for every hour that you work from home.
Correct.
Okay.
So it's good to keep some kind of record for the days and hours that you work. I know some people work more hours than others, so good to keep track of that. And then on top of that, there are some other separate deductions you can include, and they are things like office desks and computers and cleaning, but only if you have a dedicated office space. Okay, so if you set up your laptop and you're watching State of Origin and you're working, well then that you can't claim for cleaning your lounge room. But if you've got if you've got a spare bedroom in a designated space, you can include those additional costs. Okay, the second method, being the actual cost method, is a bit more onerous, but it's probably more advantageous for people who generally work, heavily at home and have the ability to keep track of their actual costs. So they're allowed to capture all those internet, mobile phone, electricity and gas, stationery and the like on an actual cost method.
Yeah.
Okay. The deductions can be heavier and you can claim more, but the record keeping requirements attached to that are more onerous.
And so by that you mean, similarly to the Spotify example, if you want to do the method of actual cost, your quarterly electricity bill is $300, and you say, of that quarter I worked from home, 60% of that or X hours, therefore I'm going to claim X percentage of that 300.
Yeah, absolutely. Okay. Like the ATO guidance on that says, they even say we require you sort of detailed calculations and records. So
they do require.
Yeah. So,
but what about with the 67 cents? It's
as long as you kept track of your hours that you're working from home and can justify that, it's a flat rate.
And so just on that one, because that feels like the easiest one for a lot of us who probably haven't been diligent with record keeping. If it's 67 cents for every dollar on every dollar for every hour, let's say you work 24 hours a week at home, so say 3 days a week. By 48 weeks a year, you have 4 weeks of annual leave. That's about $771.
Yep.
So that's the that's the deduction that you can claim against your income.
Absolutely.
Nice.
Yeah, against your salary and wage income.
Okay.
Yeah.
Nice. That's pretty good. So if you're home full time now, it can add up.
Yeah, I think $1,200 something, or, off the top of your head, if you're working a 40-hour week from home.
Wow.
Yeah.
Wow. Not bad. As long as you can, show a record in some way, shape, or form.
Yeah.
Now, before the show, we were speaking of deductions, and you wanted to mention concessional super contributions because that sort of is a form of tax deduction. Can you try and shed some light on concessional super, what it means, how it is tax advantageous, with the caveat, I think, that super, as we said before the show as well, is an incredibly unnecessarily complex system.
Absolutely. No, you're quite right. So super is a very complicated beast, but in short, there are two types of ways you can contribute to your superannuation. So one is concessional or tax deductible contribution. The second is non-concessional, non-deductible, and there are ATO imposed limits that you can contribute each year. ATO imposed limits you can contribute as a concessional or a non-concessional each year. Now, I guess one of the benefits of a concessional contribution, as we were discussing before the show, Bryce, was that you can claim a tax deduction for putting away for future savings, future retirement. So in my book, that's fantastic. You're really just putting money for future retirement, but you're claiming tax deduction on the way through. Now, over recent years, the ATO brought in what they call catch-up concessional contributions. And what it allows you to do, any of that unused cap, which is currently $27,500 a year, that you did not use in previous years, you can bring forward. So that is effective from the 2019 income tax year. So, depending on what you've used, you could be potentially claiming a tax, $100,000 tax deduction if you haven't used your full concessional cap in a tax year and put that in for future retirement and savings.
So let's just play this out. The first part you said was that the concessional super is you love it because it's a tax deduction now for future savings for you in retirement. How is that the case?
So, we all have our, nest egg, our super fund, whether it be in a public offer, fund with Host Plus or something like that, or whether a self-managed super fund, that you can access when you eventually retire, okay? So I know that particularly probably some of your audience are probably younger and probably don't give superannuation the attention it probably deserves. Mm-hmm. But if you think about it this way, you've got let's say you have $20,000 lying around and you're eligible after checking with your tax agent to leverage the contribution caps. Instead of putting it into an ETF or a managed fund, you go and then throw that into your retail public offer fund or your self-managed super fund, and you invest it in the same stock or managed fund or whatever it might be that you would ordinarily in your own name or in your own family trust or whatever it might be, but it's parked away for retirement and it achieves the same growth and dividend stream and whatever it might be outside of the superannuation environment. So it's locked away, yes. However, it's you're getting the same growth and benefit you would just for future years. And
there's a tax advantage in doing that, which is that it's taxed at the lower rate.
Correct. So there's two key tax takeaways from it. Firstly, you'll get the tax deduction when you put it in there, okay? And then rather than being taxed at potentially 47% being an individual, it will be taxed at 15% in the superannuation environment. So there's significant advantage two ways.
So that 20 grand you're talking about, if I have a lump sum of 20 grand and I decide to take it out of my bank account and put it in super, that's actually going to a 20 grand tax deduction on my income this year.
Correct.
All right.
But I want to say this again, Bryce, but it's very important you check that with your tax agent.
Okay.
Because things that go towards your contribution are like your salary and wage. So any superannuation that is included in salary and wage goes towards that cap that we mentioned.
Yeah.
So it's best to check with your tax agent. They'll do the numbers and say, yep, your unused cap is X. You can put up to X in. And if you go over that, there is some what they call excess contributions tax that you need to consider. So very important, again, check with your tax agent prior to doing it.
Nice. So I guess then at this time of year, you often see people trying to max out that super cap. And
Yep.
so that's what they're doing. They're just saying that of the 27,500 or whatever is available for me to put in additional concessional contributions, if I've got some spare cash, I'm just going to max that out and take advantage before the new tax year rolls around.
Yeah, absolutely.
Yeah, nice. All right, well, that's it for the deduction side of things from the Equity Mates community. Now we've got a bunch of investing specific ones that have come through from our audience as well. Rightly so, one that continues to pop up every time is around franking credits. Now, can you please explain franking credits? And this is from one of the members of our community. What do I need to know about them at the end of financial year?
Have you got 6 hours or?
I know.
Yeah, look, this is one of my favourite topics, and
Wow.
and it is a very complicated beast, and you might remember Bill Shorten tried to play with everyone's franking credits and everyone got upset, and that was a bit of a failure. So don't touch your franking credits. But it is very complicated. But to make it to put it across in the simplest way possible is the principle behind them is that companies in Australia, they're corporate entities and they generally pay tax at 30%, okay? And then when that company declares a dividend and pays it out into Bryce's hands, the principle behind it is they don't want that post-tax profit being taxed twice again in Bryce's hands. So there is what they call a 30% credit attached to that particular dividend, okay? And that, to you personally, Bryce, is refundable. Sorry, it reduces existing tax that you may be payable, but it is also potentially refundable depending on your individual circumstances. It's also, you've got to consider what entity receives that dividend. So, for example, a company can't get that refunded, but it will reduce company tax, okay? Super fund receives the refund, and individuals receive refunds, but companies do not. So this is where the technicalities come in, because often, depending on the recipient, depends on the actual tax treatment.
And so during the year, I'm paid dividends that are fully franked, meaning that for the entirety of that dividend, the tax has been paid by the company.
Yep.
And so it comes with that franking credit that I will get refunded at tax time. Are there any other uses for that credit, or is it just a direct refund?
Not always a direct refund, okay? So if you are a high wage earner and you're on the highest marginal tax rate, you will pay what they call the gap tax between the company tax rate and your higher rate. So it will reduce you by that particular franking credit portion. Yeah, it will only result in a refund if your circumstances allow it to, if you know what I'm saying.
Yeah, and do I have to? Is it done automatically, or do I have to? If I'm getting Vanguard dividends every quarter and I'm getting BHP and CommBank, do I have to be like, okay, that was fully franked, that one was 70%, and then somehow do all the maths at the end of the day?
Yeah. So look, that's a good question. So historically, you had to do a lot of this manually, okay? But the ATO have very good data matching capability now, and often when you open up an investment account with a particular provider, you provide your TFN and a whole bunch of personal details, and they report that annually to the ATO. So, when we as tax agents log onto your profile in our tax agent portal, we'll see a lot of that, and a lot of that can get imported and pre-filled into our softwares. So that removes, I'll call it, a good chunk of that. However, there are still sort of platforms, or I'll call it people who made an investment 20 years ago that's sitting on some platform or some brokerage account that hasn't got a TFN located to it. So you've still got to go through the manual process of tracking the dividends, tracking the franking credits, what's franked, what's not franked, and things like that, and cross-checking it. You can't just sort of rely on what's fed to you from the ATO.
Again, it seems like a unnecessarily complicated system, given I feel like many countries around the world don't do franking credits. It's just like, make it simple, pay us the dividend and let us pay the tax on it.
Yeah, absolutely.
So we've got a few overseas listeners, but we also have many of our listeners investing overseas and receiving dividends and income from investments overseas. So what are the tax implications for receiving income from overseas sources or overseas assets?
Look, assuming you are an Australian resident for income tax purposes, a foreign asset is largely treated no different from an Australian asset. If you got an interest in a US stock versus an Australian stock, there's no real difference, right? The capital gain is treated the same. The dividend stream is treated the same. It falls into your pool of income for the year, and you get assessed at your individual tax rate or whatever entity you might hold this particular asset in. Where it can be different and be a little bit difficult or different to track is that some of these particular, I'll call it foreign income streams, have foreign tax credits attached to them that you can claim in your refund, in your tax return. So that is where it's different. Different jurisdictions have all different nuances of how they withhold tax and all this kind of stuff. So
right.
You've got to keep track of that and make sure you capture the correct credit in your returns.
All right, another one from the community. We encourage on the show to take advantage of dividend reinvestment programs or plans. Just get that compound going over a long period of time, reinvest those dividends. But what are the implications from a tax point of view? I haven't actually received the income in my bank account. Is it treated the same?
Yeah, unfortunately, it is treated the same, Bryce. It's the view is it's exactly the same as receiving physical cash.
Right.
You've received another asset in place of cash. It is accessible to you on the date that you receive that asset or receive that cash. So really no difference, and you also get the benefit of the franking credit that might be attached to that as well.
So just to follow on from that, another question was around dividends. Is it the X date or the pay date that counts as the point of recognition for tax?
Yeah, as an individual, it is the pay date. So as you're probably quite aware, a company might declare a dividend in February, but you might not receive the cash until August.
Yeah.
And 30 June being the Australian end of tax year cutoff, that will fall into the time that you actually receive the cash into your bank account.
Okay, nice. So for those of us who have lost money, which is a lot of us at various points in time, when you get to the end of the tax year, you have a decision where you can sell your losses for a capital loss and use that against capital gains in the future. Do capital losses have a use by when you're deferring them? I.e., if I had a capital loss from 10 years ago at uni on one of my specky stocks that I have recorded.
Or your Bitcoin losses?
Yeah, all my Bitcoin losses. Can I guess it's a two-part question. If I hadn't have recorded that loss in that tax year, can I retrospectively go back and say, I actually had a capital loss back then, here's the record? And secondly, if I did record it back then, but haven't used it against a capital gain until now, 10 years later, is it still active?
Yeah, sure. So first question, absolutely. So your capital losses are carried forward, indefinitely, okay, right? But it's very important that when you're completing your tax return, you capture that in your what they call your CGT losses schedule and in your losses record, so that will sit there and pop up in your tax return each and every year that you lodge your tax return until such time you go and use that, okay? And also, it's important to note that capital losses can only be used to offset capital gains that can't be used to deduct against any other accessible income. So if you've got a salary and wage, but you've made a loss on a stock, unfortunately, you can't deduct that against that. Okay, so it's specific to capital losses and capital gains only. Now, if you made an investment and you made a loss, 5 years ago, 10 years ago, the correct way is to technically go back to the year in question and amend your return to include that loss. Okay. If all of a sudden you had a big loss just pop up in a tax return, you might trigger an ATO to look at it and say, oh, hang on, you made a large gain this year and you've pulled this loss. Please provide the history behind it. But if it's included in your return every year, the ATO can track it, they can see it, they've got visibility of it, and it's less of a surprise when you go and utilise it, if you know what I'm saying, when you use that loss. So.
Okay, that's interesting. So you can do it, but you need to go through the formal process of amending that tax return.
That's
so that it's then formally recorded.
Yeah.
And then just to clarify, if I'm doing tax return myself online, where do I record those capital losses?
Look, it's a bit of a tricky part of the return,
Okay.
of the I return as they call it. There is a specific section in there, and you generally complete what they call a capital gains tax worksheet that should pre-fill that. As I said, it is complicated.
Okay.
Because you've got to include things like discounted and non-discounted gains, and you've got to apply losses in the correct order and the like. So my strong suggestion would be if you've got a material capital gain or loss that you're looking to include on your tax return, is to get a tax agent to review it or to complete that for you. Just because we've seen we often get clients come up to us at the end of the year and say, "Hey Andrew, I've done my capital gains calc. This is what it is," and then they're off by hundreds of thousands. So.
So for those of us who have been burnt by Bitcoin over the last 12 months, strongly recommend seeing a tax agent.
And I'll add one thing also, Bryce. Depending on what platform you invest on and things like that, a lot of these platforms will give you tax statements where they've done the hard work for you. So strongly implore your listeners to download your tax statements, and they'll say, this is what you bought, this is what you realised, this is what you unrealised, this is what your discounted gains are, and things like that. So that will take some of the grunt work out of it. But if you're literally just buying and selling, and you don't have a platform that manages that aspect for you, then you've got to be able to do the calculation yourself.
Just on that, confirming that from a tax point of view, unrealised gains or losses mean nothing.
Correct. They, again, I think one of your further questions that we'll touch on is not accessible until it's realised.
Yeah.
So you can hold on to an asset forever and a day, and it will,
Sweet.
Yeah.
Now, is there any difference in tax rates for dual listed assets, such as ASML or a lot of those companies that are listed in America, but also over on European or here in Australia and in America as well?
Yeah, no. So the short answer is no. So I think we're going back to your question on foreign assets and the like. The same principle applies. Just because a stock is listed on one particular exchange and also on another doesn't change the way, in the eyes of the ATO, that asset or that income stream off that asset is treated as a tax resident in Australia. Again, it doesn't matter if it's Australian or overseas or what exchange it's on. It's still the same income stream, or it's still the same capital asset. Okay, but again, where things might differ is on whether any credits attached to that, foreign tax credits attached to that might change across different jurisdictions and different listings.
All right, two more to close out on investing around dividends. Firstly, for those that are weighing up the tax benefits of capital growth compared to dividend payments, how would we think through that? And then when reporting dividends, is there a minimum that I need to report? That would be nice.
I'll start with the first one, and the answer is your first cent of dividend needs to be included.
Any dividend income.
Any dividend income. There's
not getting away with it.
There's no secret dividend income that you don't include. Unfortunately, your first cent that you derive needs to be captured in your tax return. But going back to, I'll call it the first part of the question around capital growth versus dividends. So, as we alluded to earlier, you can buy an asset. It could be a house. It could be a portfolio of shares. And as long as you don't hold on to those, you'll never pay any capital gains tax on that growth. It's only when you realise and sell the asset that you've got a CGT consideration. Contrary to that, dividends, obviously, your first cent that you receive in a particular year, you need to declare on your tax return, include on your tax return. So there is a consideration on an annual basis for that. But two things to consider when you're weighing that up is dividends. Generally in Australia have franking credits attached to them, and depending on your circumstances, can result in potential refunds to you or reduction in your tax. Similarly, capital gains can be subject to what they call the 50% discount, okay, and can reduce tax. And if you do have capital losses available to you, and you can also offset those with your losses. So there's pros and cons of each, and it all come down to your circumstances at the time. Well,
Andrew, we're going to take a very quick break, but on the other side, we're going to close out with some of the general tax questions that have come through from the community around self-managed super funds, tax on your spouse's income, medical expense deductions. There's plenty to go. So let's take a quick break and we'll pick it up on the other side. Well, welcome back. We're here with Andrew Wilson, Managing Director at Wilson CA, Chartered Accounting. Is that right?
That's
Chartered
it.
Accounting,
That's
yes. So, Andrew, we've had plenty of questions come through from the community on deductions and investing. So we'll close out this episode with some general ones. And I'll start with one which is around self-managed super funds.
Sure.
Worth it or not for people our age-ish, sort of early in their careers, but starting to develop a decent-sized nest egg?
Yeah, look, that's a good question. So technically, unless you're licensed, we're not allowed to give, I'll call it superannuation advice. But the commentary is generally around, unless your fund is up to around $300,000 a year, in a balance, then it's not really worth the administration and costs and burden attached to running a fund. Generally, if one of our clients is looking to invest in start a self-managed super fund, there generally needs to be a strategy around that. They might be a small business owner and they want to acquire the premises that they operate out of in their superannuation or something similar like that. Otherwise, it'd make your life a lot easier being in a public offer fund where all the administration cost and headache is managed by someone else, and you don't, as trustee of your fund, have to carry that.
All right, so this one has come in. If an individual's spouse earns a lower income, are there any strategies available to help reduce the overall combined tax burden that the couple face together?
Yeah, look, this is something we get asked quite a lot, and there are ways and means of sharing income around the family, okay, but it often depends on how that income is derived and the nature of it. So to give you an example, Bryce, you used to work at Woolworths, your large six-figure salary that you used to have there. That's your salary. You can't go and share that, with your partner. That's personal exertion that belongs to you. However, if you have an investment asset or an investment portfolio, there are ways and means of sharing that amongst the family group. Now, these are generally, the manner in which that is done is via what they call a family trust or a discretionary trust, okay? And they are also a very technical beast, the way the mechanism and the foundations of how a trust works. But to put it across as simply as we can, they are assets that are held for and on behalf of the beneficiaries, or in this case, the family group, and it kind of works like a family tree. So you'd have husband and wife at the top of the family tree, or the partners at the top of the family tree, and then brothers, sisters, aunts, kids, and things like that. So it gives you flexibility that the dividend flow and the capital gain flow out of that pool of assets that are held by that trust, it gives them the trustee discretion to share that amongst the family group, okay? And there's rules around that and how that needs to be done from I'll call it a tax compliance perspective. But it does give you the ability that, if your wife's on maternity leave and you've got a pool of assets and dividends coming through, that you can the trustee can allocate that flow of income to the lower income earner for the year in question.
All right, so another general one. Can out-of-pocket medical expenses be deducted?
Unfortunately not. I think it was 2019 tax year was the last year where they used to be called out-of-pockets medical expenses offset. So where there was, for people who had incurred medical expenses over a certain value, that you could, it wasn't a deduction, it was an actual tax offset with a calculation behind it. But the long and the short of it is that's no longer available. Medical expenses are not cheap, but unfortunately they're deemed personal in nature, and there's not much you can really do there.
Yeah, it is what it is.
Yeah.
Now, what are the potential benefits or considerations of structuring one's income as a business entity instead of paying personal tax, and at what income level does this start to make sense? Now, I'd be interested to know if this is even possible other than becoming a sole trader or a contractor. Like if I was at Woolies, I couldn't start structuring my income as a business entity. No,
you're quite correct. So investing is a passive activity, right? Like you're not actively engaged in business. You're placing money into and developing an asset pool. You're not buying and selling widgets or providing a service. So you couldn't say that structuring an investment portfolio as a business, it doesn't work that way. But what I will say is, if you are genuinely undertaking a business, and whether it be a professional services business, a construction business, whatever it might be, seeking the advice to get your correct structure in place from the outset is so vital. Similarly with an investment portfolio. And the reason I say that is, if you were to start a business tomorrow, Bryce, and it grows in 10 years' time to be this, behemoth, that if you haven't got the right structure in place, then you could be slammed with full capital gains and all this kind of nightmare that I find people come to me in 5-10 years' time and say, Andrew, I've built this business, but I've done, I skimped on advice to begin with, and now you've got a capital gains issue to unwind. And similarly with an investment portfolio, okay, if you kept on investing with the incorrect structure without having due regard to your family circumstances and your future goals and aspirations, then you could end up with this big pool of asset that you're going to pay unnecessary tax on when you eventually sell or exit that particular investment.
Nice, Andrew. Well, that brings us to the end of our end of financial year tax special. We do one every year. It was great for you to join us in the studio. Plenty of questions to get through there, and I hope we covered enough off for the community that they feel a little bit more confident on how to approach the end of financial year tax time. I think just one question for me about setting yourself up for FY24 is just around best practice for record keeping, because there's obviously heaps of stuff that you could do around dividends and when you bought and when you sold and everything to do with working from home. I think just to make it as simple as possible, what I've taken from this is just if you can have a decent representation of how you have used your work from home environment and those sorts of things, then that is, I guess, good enough. And then when it comes to tax and dividends and when you've purchased stocks, a lot of the platforms these days do it for you. But if they don't, that's where you really need to make sure you have a pretty good record keeping system so that capital losses particularly you can report.
Yeah, absolutely. I mean, there's no excuses now, Bryce. Like, everyone's got access to all their computers, all the apps. If you need to log your driving, you've got the ATO give you a digital logbook, all this kind of stuff that right. That back in the day people used to say, my logbook that I kept in my glove box, I sold the car and it's disappeared, that kind of stuff. So now there's no excuses, and it shouldn't be that onerous. As long as you're reasonable and rational, then you should be well prepared to prepare your tax.
Nice. Well, we certainly do appreciate you coming on, answering all of our questions. If anyone wanted to find out more about you, or in fact actually go and see a tax agent like yourself, where can they find you?
Yeah, sure. So our website is www.wilson-ca.com.au, and you'll see all details on how to contact us there, or feel free to drop us an email on info@wilson-ca.com.au.
Awesome. Well, we'll make sure that we put that information in the show notes if you would like to get in contact with Andrew to get sorted for this tax year or set yourself up for FY24. But again, thank you so much. It's been an absolute pleasure. We really appreciate it.
No, it's been fantastic. Thank you.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present, and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.